Welcome to Sustainability Bridges, a Eurosif podcast that aims to build bridges between policymakers, investors, academics and civil society around the theme of sustainable investment. Eurosif, the European Sustainable Investment Forum, is the leading pan-European association promoting sustainable finance and investment at the European level. In these podcasts, Eurosif's Executive Director invites distinguished guests for a 30-minute conversation on current events shaping the sustainable investment community.
Hello everyone, my name is Pierre Garrault and I am Senior Policy Advisor at Eurosif, the European Sustainable Investment Forum. For this episode of Sustainability Bridges, I am honored to be joined by Nathalie Dogniez, Chair of Eurosif, and an independent director sitting on the boards of funds managers, and non-profit organizations. Nathalie has more than 30 years of experience within the financial sector, auditing and advising funds and asset managers, and has spent more than 20 years focusing on ESG and sustainable finance. Together, we are going to discuss the perspective of the financial industry on recent and future developments in EU sustainable finance, including the European Commission's proposed omnibus initiatives that would reopen several key regulations, and the recent political shift towards focus on competitiveness and growth. We will also look at the importance of access to high-quality, comparable and reliable sustainability data for investors, and what measures need to be taken to increase investment flows to finance the transition to a more sustainable economy. So Nathalie, many thanks for joining us today. And first of all, maybe for all listeners who may be unfamiliar, could you briefly tell us about your background, how you came to be involved in sustainable finance and also in Eurosif?
Thank you, Pierre. Yes, I've been spending a lot of my career as a financial auditor or as a, I would say, regulatory and sustainability advisor. So I've spent more than 2 decades investing or dealing with sustainable investing. Worked a lot on SFDR implementation, EU taxonomy implementation, but also spending a lot of time with hands-on experience on dealing with sustainability data challenge. So throughout this time, I have been a great supporter of Eurosif action for many, many years, as Eurosif mission is so much aligned with my personal values and belief. Therefore, when I learned that Eurosif was extending its board of directors, I was really happy to apply for the independent director position and was thrilled to be appointed as director and even more happy to be elected as the chair.
And we're very happy to have you as our chair, Nathalie. So, as you mentioned, you have decades of experience in sustainable finance and asset management. There has been a lot of developments in sustainable finance during that time and a lot of evolutions in the practices of financial market participants. Could you share with us some of the major developments that you witnessed within the financial industry?
Yeah, well, in the early days of this century, it was really perceived as being a niche market, sometimes really unknown to the public. But since a couple of years, should I say 2020, maybe a little bit more, we have seen a tremendous increase in the interest in sustainable investing. But sometimes, personally, I had the feeling that it was maybe going too quick. And maybe sometimes also there was a little bit of the hype element, which implied that some of the less convinced players may have changed their mind in the recent years, triggered by the short-term impact of energy price, for instance, affecting short-term performance. But overall, we can say that integrating sustainability consideration into investment decision has become the norm for investor and for manager when they take a medium to long-term view on their investment performance. Indeed, ignoring sustainability impact exposes investors to future financing risk. So we have also witnessed a significant increase in the knowledge, competence, and sophistication of both investors and market players. For instance, we have been moving from a simplistic black or white approach, determining whether an asset is sustainable or not, throughout more sophisticated investment strategy to finance the transition. The EU Sustainable Finance Framework has in that context been a game changer, providing definition, assessment framework, for instance with the taxonomy, and very importantly, transparency. because without data, you cannot ensure that your investments are rightly allocated, and you cannot ensure that the portfolio meets the sustainability or transition ambition KPIs.
So as you mentioned, the evolution in maturity of financial market participants was accompanied by regulatory developments at the EU level. Focusing on those pieces of regulation, could you share some examples of where they helped also asset managers develop their practices?
If we want really to finance a transition or to finance sustainable investment, we need data and we need common methodology to measure, for instance, transition effect. And the sustainable finance framework have been providing for this. For instance, transparency on the portfolio sustainability ambition and KPIs, how to measure how these, I would say, ambitions were achieved with SFDR. Another example is the framework to assess whether an activity is sustainable or not, at least from an environmental standpoint, with the EU taxonomy. And very importantly, a unified methodology and structured way for companies to report sustainability information with CSRD. This is a very important piece of the jigsaw. Indeed, without comprehensive, comparable, and reliable data, you cannot determine whether a company or a project is worth investing in.
So now zooming in on CSRD and the EU taxonomy, could you explain why the availability, reliability, and comparability of corporate sustainability-related disclosures is essential for investors, and how does it relate to the other EU priorities, which are currently competitiveness and growth?
So why is disclosure important? As I said, without data, you cannot really make proper investment decision, deciding whether a particular company, whether a particular project is really forward-looking. You cannot really measure whether you're achieving your ambition, your KPIs at portfolio level in terms of transition, in terms of sustainability. You cannot really measure whether your portfolio is exposed to sustainability risk or stranded assets or product risk. And then you cannot report to your investors on progress made towards your KPIs. I would say competitiveness is not just about cost cutting. It's also about making the right investment for the future, looking at growth in the medium to long term rather than just focusing on today's margin and profit. It's about investing in decarbonization, not only because it's the right thing to do for European citizens, but it is also because it will save climate change adaptation costs in the longer term, which are expected to be much higher than the cost of investment in climate change mitigation. But also because this represents the future of our economy. And this will also protect companies for climate risk and financial risk stemming from stranded assets or products.
And you mentioned CSRD and sustainability data as a key point here. But nowadays, the political narrative at the EU level seems to be shifting towards the simplification and streamlining of EU sustainability rules, and in particular CSRD. The European Commission will soon publish an omnibus initiative that will target the EU taxonomy, CSRD as we mentioned, but also rules on sustainable due diligence, or CSDDD. Do you feel sweeping changes to these rules are necessary? And what could be the consequences of changing these rules for investors, but also for the companies that are currently applying or preparing to apply those rules?
Indeed, we hear a lot of criticism, and that's human nature. But these criticisms are mainly coming from companies that are not really ready to make, long-term investment in future technology and clean energy because they are focusing on short-term margin. On the contrary, for instance, the taxonomy have been actively used by companies investing for their future and future growth and competitiveness. Now, having said that, there is not a single piece of regulation, not a methodology, nor a reporting standard which have been perfect on day one. And there is no transformation exercise that have been coming without pain. And adapting to climate change is a huge transformation. but it is absolutely required to maintain Europe's competitiveness and growth in a changing paradigm. So you mentioned about simplification. Yes, simplification is required to adjust, to recalibrate the reporting standards based on the experience we had with the taxonomy, for instance. But on the other hand, we must ensure that we keep the ambition of the sustainable finance framework. Because without proper definition, without proper data, investment in transition, investment in sustainability is not possible. So, what would be the implication for companies if suddenly we were watering down or removing, the CSRD, ISRS, or the taxonomy? Let's focus on the taxonomy, for instance. And imagine that you would simplify the taxonomy and remove some of the criteria, technical criteria, because some companies didn't make that. Well, that would in fact penalize the earlier mover, those companies that have invested in the transition. And that would be a terribly bad sign for those who are ready to invest in the future for Europe. The same applies for corporate reporting. Today, in the absence of streamlined sustainability reporting, companies looking for investors worldwide are facing diverse and many requests for data under different reporting standards, SASB, TNFD, ISSB, GRI, or even bespoke request of data. ISRS will be a game changer, a one-fit-all structured reporting. Now, indeed, as all new reporting, year one of implementation is challenging, but going forward, it will provide competitiveness hedge for European companies. Just imagine, in a few years' time, investors, when they want to invest in European company, they will have direct digital access to financial and non-financial data in a structured way. What a competitive advantage for European companies looking for financing.
So President von der Leyen also has recognized that industrial decarbonization is a priority for Europe. Obviously, this requires significant investment in the economic transition. In this context, could you elaborate on what needs to be done to increase investment flows to finance this transition? How does that relate to the EU Sustainable Finance Framework as well?
Increased capital flow can only come with adequate and reliable data. This is why it's so important that companies report on their transition plan in a structured way and a way that is verified by third party. But not only, because climate change is closely intertwined with other environmental challenges, such as biodiversity. And if we want the transition to be just for European citizens, the S factor shall not be neglected. We also need common methodology to determine what is sustainable, what is a proper transition. So we should continue to work on taxonomy, covering more activities, and we should also work on a common social framework on the S factor. And last but not least, we need clear financial product categories, including a transition category under the SFDR review.
And you mentioned the SFDR review, and here the modifications on the omnibus will also play a role indeed. If we want to support transition, we need clear information from investee companies on what their transition trajectory is about, which includes forward-looking metrics such as climate targets and transition plans, which are essential for investors to assess their credibility.
Yeah, without this data on climate targets, on transition plan, but also on the wider, I would say, environmental impact and social consideration, we cannot really achieve all of these. And the entire, I would say, sustainable finance framework run the risk to fall apart, and Europe may be losing the competitiveness hedge that it has acquired so far.
Thank you, Nathalie, for joining us today for this insightful conversation.
It was a pleasure.